Hey traders, Barry Burns here with Top Dog Trading. Today, we're going to answer a question that has come in from several viewers, and that is about the use of pre-market data, post-market data, basically extended hours data for day traders. And the answer is, let's bottom line this puppy dog first, and the answer is yep, I do use it. Absolutely 100%. So let me give you the reasons why, but then also let me take the counter argument and tell you why you should also look at a chart and market that does not have pre-market data for a very good reason. So we're going to kind of combine the benefits of both. So first of all, we want to use extended market data because of the pivots. So I love me some pivot lines. And when I talk about these, I'm talking about the traditional floor trader pivots, the traditional calculation. That's what I like to use. I find it very helpful. In fact, if you look at the chart in front of us right now, you'll see that we've got a cluster coming in here. It comes back up. There's resistance. These are mid pivots that come in here. So there's support resistance levels. And like anything, they can't be used in isolation, but in conjunction with other indications of the flow of money. We look for strength or weakness coming into these support resistance levels, and they're very, very important. They're decision points. So if we go back here, you can see again, we come into this. Now, this is a very short-term chart. And by the way, this, as you can see, is the micro E-minis for the NASDAQ. 200 tick chart, super fast chart. So because it's such a short-term fast chart, you're going to get a little more noise around these levels. It'll go a little bit above, a little bit below. If you're using a longer-term chart, then these levels will come in more exactly at them, like a 5-minute chart or so. But even there are two, as you see, mid-pivot, beauty. R1, yesterday's high, that's included, by the way. So, okay, now the key is that these levels should be calculated with pre-market data. In other words, 24-hour data. So if I go in here to my data series, and I want to, this is what I use, by the way, I use 24 times 5. So that's 24 hours. 5 days a week. And this is very important. There's also an option here in NinjaTrader for 24/7 days. So that would include Saturday, which there's no real trading on Saturday, but Sunday there is. And I do not include Sunday data on there because if you do, I mean, you could, and it's not a bad thing, but if you're using automated pivots like I am, my pivots automatically calculate. So when you're using an automated pivot indicator like I'm using, then it's going to plot them for Sunday as well because it's based on a mathematical formula. You can Google it, it's public. That's based off of the previous day's high, low, and close. So for Monday, you would get the pivot levels calculated off of Sunday's just short trading day, which is normally a narrow range trading day of its high, its low, and its close. And going into Monday, that's not going to be as helpful for you most of the time. So for that reason, I don't use the pivots from Sunday. For Monday, I use the pivots, or the high, low, and close, I should say, for Friday for Monday. So that's one distinction. But the other distinction is when I come in here to my pivots indicator, and let's get down to that. There we go. All right, so you've got choices, and so you can use daily bars. Do not recommend you use daily bars. You can use or define values. That's fine if you want to do that. Then you would manually put in the values based on, you'd go to the exchange's website, and you would type in the previous day high, low, and settlement. You can be even a little more exacting there with settlement. Not as big of a deal as it used to be. And so I don't actually do that anymore. I used to back in the days of yore. But these days I just use it, calculate from intraday data. Now, using the intraday data, I do indeed want that post-market data, that 24-hour data, just all the data I can get. I want it all. I want it all. Because sometimes you will get highs or lows during the pre or post market that were not available, did not occur during regular market hours. So the regular open, so to say. But yes, I have found that it's definitely better to use the highs and the lows, including the pre and post market data. So that's a huge one. Okay, so that's one thing, is the pivots. Now, the other thing here is just how the markets will move, and it kind of depends on how you trade. So this will apply more for certain traders than others. So I live in California, so the market official open is at 6:30. So there we are, 6:30, okay. And if you use any type of wave counting or swings, symmetrical type of pattern recognition that you're looking for, then the advantage of using pre-market data before the open is your wave counts will go more smoothly. And yes, I do count waves and look for highs and lows and all of that kind of stuff. These swings, I do continue them from pre-market. And if I didn't use pre-market data, I would continue them from the previous day. In other words, people have asked me the question to come in, hey, do you start new wave counts with every new day? And the answer is no. I base it based on a continuous chart, the continuous data. So if a trend keeps going today that started yesterday, I continue to count the waves that started yesterday. So good question, by the way, for those who sent that in. But here is pre-market. And so as you can see, you just continue the nice little sine wave patterns. Whereas if we went to if we take that out, and we don't use pre and post market data, trading hours, I think it's going to go off the chart here, or the visible area for you. But now I'm just bringing up U.S. equities real time hours. And so now in between the days, let's see if we can get back here to 6:30. And each day is a little different. Oh, well, there is a good example. Okay. So you see, now we closed there, and then we opened here. So that's yesterday, this is today. By taking away the pre-market data, what we have done is we do not have a nice symmetrical pattern or a wave count continuation or a trend continuation, but we do have an advantage that we're giving. It's always a give and take. And the advantage we're getting is we see a gap. And gaps are good to see. And if you don't have the pre-post market data, you don't see the gaps. So here's what I do. Bottom line this whole thing for you. I do include pre and post market data on my charts, but I'll pull up a chart without it and I'll look for the gaps. And I'll just go ahead and mark a line. I'll say, okay, this is where we closed yesterday. And I will put that line, a horizontal line, on the chart that includes the pre and post market data so that I'm aware in my head, all right, I know that we've got a gap today, and I'll mark it on my chart and be aware that that's where the gap would close. So there you go. And that to me gives me the best of both worlds. That's it, my friends. By the way, if you want to get my rubber band trade, highly encourage you to get it. Just got a letter again yesterday from someone who's making money with it and said, thank you very much. Appreciate that you help me make money without charging me anything. And that's exactly what I'm doing. So go to rubberbandtrade.com, and there you'll get 5 free video lessons, and it includes my rubber band trade, which I give away for free. And I'll tell you, I still take personally that rubber band trade every time it sets up.